Today, I want to talk about the massive market crash that's coming and how that will cause the AMC squeeze, and also how really we've been winning ever since the AMC bankruptcy was off the table. So stay tuned and let's make some money. So let's dive straight in with the key information. You may already know the big news from the weekend, which is that Moody's, the rating agency, just downgraded the US credit rating for the first time in history. Of course, back in 2011, Standard & Poor's, another ratings agency, downgraded the US credit rating, but this is the first time Moody's in history has downgraded that rating as well. We can see their reason for cutting the US credit rating was due to rising government debt. Many of you may have seen this website before, which is the US debt clock, showing the US national debt, which right now is totaling $36 trillion, nearly $37 trillion. The US debt has absolutely spiraled and skyrocketed over the last 5 years since 2020. We can also see the US federal spending and the federal tax revenue giving us the federal budget deficit, which has also been skyrocketing over the last few years, mainly due to the massive increase on interest costs on that debt. Of course, due to the high interest rate in the US. Again, that's shown to us right here in the middle of the page. Interest on that debt is $1 trillion every single year. So if you didn't know, Moody's have cut their credit rating of the United States down from AAA to AA1. A fairly small drop, but an important drop all the same. On a fairly similar note, Citadel's credit rating, many would expect to be up here, is actually right down here at Baa3, one step above junk. But anyway, back to the US credit rating. We can see here from Wikipedia, Standard & Poor's reduced the US credit rating from AAA to AA+ back on August 5th, 2011, which had a pretty profound effect in the market. Between the morning of August 5th and just a few days later, quite literally 3 to 5 days later, the market dropped nearly 12%. Obviously, as of today, on Monday, we haven't yet seen that same impact from the Moody's downgrade, but it wouldn't surprise me if a further crash is just around the corner. Of course, since February, we've already seen the S&P 500 actually crashing officially by over 20%, by 21.5%. Of course, over the last few weeks, we've seen the market gap and rally, but on many occasions, just as you think the market is recovering, it then proceeds to break the bear flag and crash even further. For example, in 2022, we saw the market crashing by 14%. It then recovered by most of that drop. It recovered by 12.5%, only to go on and crash another 25% after that. A further 25% drop from today's level would take us to around $450 in the S&P 500. Something very plausible, as that's exactly what we saw in 2022. Especially as Moody's didn't just downgrade the credit rating of the United States, they also downgraded the rating of JP Morgan, Bank of America, and Wells Fargo. And what's potentially even more worrying than that is that billionaire Ray Dalio said the risk to US Treasuries is even greater than what Moody's is saying. So actually many billionaires out there are thinking that actually the United States is in even more trouble than Moody's is saying. Now, Moody's on Monday downgraded the long-term ratings of top American lenders such as JP Morgan, Bank of America, and Wells Fargo, after pushing the US out of top AAA rating club over its burgeoning $36 trillion debt. It also downgraded the long-term deposit ratings of B of A, JP Morgan, and Wells Fargo, and cut the long-term counterparty risk ratings of certain rating subsidiaries and branches of Bank of New York Mellon and State Street. So interestingly, Moody's is also saying that actually long-term deposits aren't as safe as they were in Bank of America, JP Morgan, and Wells Fargo, meaning they're potentially at risk. Now, especially after the start of 2023, we know that deposits held at banks being at risk isn't anything new. We've already seen banks collapsing in just the last couple of years, and it wouldn't surprise me if more collapses are on the horizon, especially if this debt continues to spiral out of control, and especially if President Trump can't get the interest rate cuts he so desperately needs. The banks will be struggling just as much, if not more. Now, I also wanted to touch on this chart, which is of course the AMC price chart and the OBV. Smoke Shorts tweeted saying that AMC is the biggest financial nuke ever, created with knowledge and patience by retail. The OBV is still my favourite chart of AMC that I've ever seen. Again, consistently showing the OBV is still increasing even today through 2023, 2024 and 2025. The OBV on balance volume is showing us basically the split of buy orders to sell orders, showing us over the last 5 years there's been more buys than sells, and even over the last couple of years, even over the last year, buys are still outweighing those sells, showing us that actually the price of AMC is falling for a different reason as to what you'd expect, which is the supply and demand equation. Of course, there's been more buys than there has been sells, which usually means the price goes up, but still AMC's price is falling, even with more demand than there is shares available. Now, Gmerica has tweeted saying that really, we've been winning since bankruptcy for AMC was officially taken off the table, and we're now just waiting to get paid. And that's something I absolutely agree with. In 2021, 2022 and even 2023, AMC was in real risk of going bankrupt. They were taking significant losses, and especially in 2020 and 2021, they were generating practically zero revenues. But now, of course, the box office and AMC is continuing to go from strength to strength to strength to strength to strength, even with theatrical cuts and theatrical strikes. Now, guys, as you know, gold is in a massive bull market, hitting new all-time highs, with many experts expecting gold to hit $4,000 this year or next. Now, this is brilliant news for us, as there's many short sellers like JP Morgan with short positions potentially larger than their entire asset base. Now, on top of this, Trump signed an executive order a few months ago to unleash American energy, bringing gold mining and other precious metal mining back home to the United States. But there's one problem. Existing gold mines are being depleted faster than new mines are being discovered, and faster than reserves are being replenished, with no major gold discoveries since 2016. That means gold will continue to get more and more lucrative and rare, causing the price to increase further and causing even more trouble for those shorts. Since 2011, the price of gold has appreciated by 75%, but the GDXJ, the Junior Gold Miners ETF, has depreciated by 63%. But just this last month, legendary investor John Paulson agreed to acquire 50% of the undeveloped Donlin gold deposit in Alaska for $1 billion. Which brings me perfectly into the sponsor of today's video, which is AXCP Ventures, ticker symbol GARLF. AXCP's business model is simple. They acquire orphaned and undervalued gold mines for less than $5 per ounce. They add value by bringing capital, scale, and liquidity to start drilling those deposits, and then market and sell those mines for over $40 per ounce. Their thesis is based on the case studies of previous instances where similar situations have led to meaningful appreciation. AXCP's current assets of 5.57 million ounces of gold equivalent resources in the measured and indicated category, and an additional 0.5 million ounces in the inferred category, based on their current market capitalization, are valued at just $6 per ounce. On average, other developers are valued at $49 per ounce, presenting massive upside. On top of this, Unlike some of our favourite companies, AXCP has seen some huge insider purchases, totaling $1.2 million in Q1 of 2025 alone, showing massive management confidence. And that management has been involved in the discovery of over 20 million ounces of gold with previous endeavours. So research AXCP Ventures, ticker symbol GARLF, on the OTC markets today. And finally for today, I wanted to talk about some regular AMC FUD because I actually found this one quite funny. So B. Riley Financial has just cut their AMC price target in half, down from $6 to $3 per share. Now, B. Riley Financial actually has cut AMC's price target, or their AMC price target, many times over the last couple of years. But B. Riley Financial, and more specifically their stock, also certainly hasn't been doing too well at all over that same time frame. Back in 2021, 2022, B. Riley used to trade for $60, $70, $80 per share and is now trading for around $3 per share. Clearly, B. Riley needs to focus on their own business, especially as they're receiving NASDAQ notices over their annual report delays and notifications of delinquency with the NASDAQ rules. Really, B. Riley should focus on their own price target, not their price target for AMC. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.